It's the Real Estate Podcast, across every state, city and town of Australia.
And welcome to another episode of the Real Estate Podcast, available on iHeartRadio every morning and also on Spotify and Apple and wherever you get your podcasts from. Well, the weekend is over. Yes, we are back into another I Don't Like Monday, and it is the 8th day of August for 2022. Coming up this morning, we're talking with Warren Hogan about a bunch of things, including, is the Bank of Mum and Dad potentially at risk with the current property market? And the thing to sort of think about is, could Mum and Dad potentially be exposed in the next 6 to 12 months? We'll talk about that. We'll also have a look at whether the RBA should pause for a few months and see what develops with the global pressure points internationally. If you're celebrating your birthday today for the 8th day of August, have a great Monday. You're sharing it with Roger Federer, who is turning 41. Is he retired? I don't even know if he has. I think he's still playing tennis. That I don't know. But if he's still playing, 41 is a great age. Turning 68 is Nigel Mansell, the English F1 driver. And turning 85 is Dustin Hoffman this morning. And it was a pretty bad day for the English cricketers on this day back in 1987 when Pakistan managed to amass 708 runs at the Oval. And you know when something has gone wrong when Ian Botham had the best bowling figures, which were 3 for 217. Ouch. Coming up in just a moment, we will check on your weather around Australia.
From first home buyers to property investors and everything in between. Every morning on the Real Estate Podcast. It's the Main Centre forecast with propertybuyer.com.au.
All right, let's go around Australia and check in on your weather on this Monday morning. Firstly, in Sydney, good morning to you. Expecting a high today of 17 degrees and some rain in the forecast. Melbourne, cloudy bits, but the good news is it's going to be dry for your Monday, and 14 is your high. Brisbane, ditto on yesterday. It's a sunny day with 21, and in Perth, the showers are back again today and expecting 18 degrees.
We are just as addicted to property as you are. Every weekday morning from 6:30. It's the Real Estate Podcast across Australia, 7 days a week.
So we have had these 4 rate rises, and the RBA is all about signalling their intent to you and I that they are serious about bringing the inflation under control. But you know what? We did get that memo. We got the memo loud and clear, and if COVID hadn't have raised its ugly head upon us, we probably wouldn't be in the mess that we all face right now. And this, of course, is a global inflationary problem, and the US right now is really starting to hurt. So let's bring in Warren Hogan. He's the economic advisor from Judo Bank and economist. And a very good morning to you, Warren. Welcome to the Real Estate Breakfast.
Thanks for having me on. It's a pleasure.
Well, firstly, we are not going to be getting any new inflation numbers until October. You're one person who is saying, hang on just a moment, RBA, cool your jets and pause for potentially a couple of months. Let's see what's going to happen, catch our breath, and see what those global factors and where they're going to land into the argument first before any further cash rate hikes.
Yeah, no, I think a wise strategy from here would be to sit back for a while. My calculation is that the total interest payments of mortgage holders in Australia is going to almost have doubled in this period. And because we have so many variable rate mortgages in Australia, we're going to see a pretty immediate impact. When I say that, I don't mean within days and weeks, but within weeks and months, we're going to see the results of what this first wave of rate hikes is doing, particularly to the housing market. So I think it's worth just sitting back for a month or two. I don't think this is the end of the tightening cycle by any stretch. I think they've got a pretty clear idea that they want to get the cash rate up to 2.5 to 3. But I just don't think they should rush it all through in the next few months. They should just ease back a little bit. But there's also a case, a strategy, a tactic to get it done early and then sit back and get the pain out of the way. I'm just a little bit more cautious, I suppose, at the moment.
And looking at those two big global issues, of course, we've got the war in the Ukraine and we've got China. So if one of those resolved themselves in the next, say, 4 to 6 months, how would that all play out with the numbers around inflation starting to ease back?
Well, I think we're already starting to see the effects of the war in the Ukraine unravel in terms of inflation, in the sense that the two key commodities that were impacted, energy and wheat, are coming off. Maybe not, the problems that Europe faces in terms of supply and price, but the price of oil is now down under 100. Price of petrol here in Australia is coming off a bit, which is great. And the price of wheat's well down. And other commodities, timber's down a lot. So we're starting to see whether it's the war-related issues or the general supply chain problems of the pandemic period unwinding. But what we've learned in the last month or so is the real international story is that we're starting to see the big economies of the world slow down, particularly the United States. And if that slowdown starts to really gather some steam in the next few months, it suggests that the RBA might not have to do as much as they first thought, or they could be a bit more measured. I'm not sure, but I think it's worth observing, and the big one for me really is the United States right now.
And Australia has always been resilient when situations are at a tipping point, which is where we find ourselves. And if I was a gambler, Warren, I'd say to people, never bet against Australia's economy, because for that very reason, resilience.
Yeah, and don't bet against our housing market. I worked in banking in terms of the big four at ANZ and at Westpac when I was early in my career. And I spent a lot of time in the first 20 years of this century trying to explain to people all around the world, particularly overseas, why the Australian housing market wasn't about to fall into a massive hole. And there's lots of reasons for it, not least that our country is extremely successful economically to this day. But also, we have certain characteristics of our housing market that are important to never forget. And the one is we never have enough houses. And that is critical to the prospects of any downturn. We're going to get a downturn in the housing market. There's no two ways about it. But I don't think it's going to be the disaster that some worry about. There's certainly going to be a significant price adjustment in some markets in the back half of 22 and into 23. But we are a resilient economy. We're generally well managed. We tend to not see it so much onshore, but we are. And our housing market is a lot more resilient than many think.
And also, let's take a look at those first home buyers. I don't know if you know the answer to this one. A lot of them are turning to the bank of mum and dad to help them into their first property. A thought here is, how exposed potentially could mum and dad be if they have guaranteed the loan and something happens to Mary or Johnny, they lose their job, and I guess a double whammy, if something happened to mum and dad, perhaps their business went bust, suddenly there's real pressure there.
Yeah, and it's very hard to get data on this, and it is obviously something that's become a lot more prominent. There was a clear wave of first home buyers entering the market at the start of the pandemic, and the history shows that first home buyers tend to be about 15% of the mortgage market anyway, and then every 10 years or so we seem to have this surge of activity when house prices fall or interest rates fall, or the government provides an incentive, usually all three at once. So in 2000 and through the GFC, we saw it at the start of the pandemic. So there's no doubt that when interest rates rise in every cycle, the most vulnerable are the first home buyers who've got into the market in the previous sort of 12 to 18 months. Quite rightly, when you're a first home buyer and you're young, you take the most risk because you've got plenty of time, and of course your career is likely to see increases in income due to promotion, not just the normal increase in wages that everyone gets. So there is a lot of risk that people will rightly take on, but of course that means you're vulnerable in those early stages. And every time rates go up, that's where the pressure's felt, as well as highly leveraged investors, but that's a different story. This cycle, I'm particularly worried about it, both because of the bank of mum and dad phenomenon, getting a lot more people in, and also because of the speed with which rates are going up now. The good news is that the employment markets are holding up so far. But if that changes next week, the issue you raise comes into play. And I think there's something we need to watch very closely, because you do not want to see forced selling in any housing market. We've avoided that in broadly in the last 20, 30 years in Australia. And you'd hate to see that because of the extra leverage brought into the system, because of the bank of mum and dad, the extra risk, if the circumstances change enough that you do get extra forced selling. And I think that's something we need to watch closely. At this stage, I have no reason to believe it's going to be severe, but it is certainly going to be a key dynamic at the margin of the property market.
And finally, the stalling of the economy, I think you've mentioned as a possibility next year, but there is still plenty of gas in the tank for this year. Could that come any sooner?
It is, and what we seem to be seeing is, for some reason, I can't explain it, Australia is 6 months behind everyone in this cycle in terms of both growth and inflation. And it's good for us because we can learn from others, whether it's New Zealand, the United States, the UK. And the US is looking like it's starting to roll over now. The New Zealand housing market certainly has. I'm not sure exactly, but the numbers in Australia right up until, this winter look pretty good. I know consumer sentiment's terrible, but that's sort of a different story. That is that cost of living issue. Employment seems good. The demand for labour more generally seems good. Spending seems good. I mean, even in the housing market, we haven't seen a massive collapse in the demand for mortgages. They were coming off, but they're still at pretty high levels. And prices are adjusting, but I'm not convinced that we're seeing a rout in the housing market, so to speak. So I think it could start to happen towards the end of the year as we go into summer. And of course, if it does, that hopefully means the RBA doesn't have to take the cash rates up as much, and there's less risk that they overshoot and have an error. So I think it's the end of this year, early next year, that we have our soft patch, and it's a desirable soft patch. It's better to have a short-lived, shallow downturn in the next 6 to 9 months than leave it till later and have a big recession in late 23 or 24.
Well, it's all going to pan out one way or the other. Warren, thank you so much for coming on to the Real Estate Podcast this morning. We'll talk again soon.
Thanks for having me, Craig.
We connect you to the best real estate information across Australia. The Real Estate Podcast.